I bet you've heard that short-term interest rates have spiked in 2022. Well, you can see that in the chart with this key benchmark rate being up to nearly 4.5%. But the issue is if you go to your local bank, you're not going to get 4.5% on a savings account or even a CD there. However, there are CDs in the marketplace, if you know where to look, that do yield about the same as these key benchmark rates. Today, we're talking about brokered CDs. Stick around. Now, throughout 2022, I've been talking a lot about government bonds because interest rates there shot up very rapidly and banks were slow to respond. So there's been this differential which has made U.S. Treasuries specifically look interesting in comparison to good old-fashioned savings accounts and CDs that you'd get at your local bank. If you take a look today, recording this on October 26th, it's my daughter's birthday, the one-year U.S. Treasury is yielding just shy of 4.6%. But what I found in doing these videos talking about government bonds is people are a little bit shy or a little bit more uncomfortable purchasing these things because they're just more technical. There's a lot more to pick from. There's a lot of financial jargon involved. Wouldn't it be nice if you could just buy a good old-fashioned fixed-rate CD for a comparable rate? Well, the good news is you can with brokered CDs. So naturally, what is a brokered CD? Well, it's very simple. It's a certificate of deposit issued by a bank, but it's purchased via a broker. So think the big national brands, whether it's Charles Schwab, Fidelity, TD Ameritrade. These are CDs that you purchase through one of those types of platforms. So for example, we're looking at Fidelity's fixed income platform, which is where you purchase CDs. And I'm using Fidelity just because that's where my accounts are personally, so I have some familiarity with this. But here we go. We can see the top issue. We're looking at one-year CDs. This one's offered by Morgan Stanley Bank, and look at the coupon, 4.55% for 1 year. So this is a perfect example of what we're talking about. Now, one of the natural questions is, why are the rates of interest so much higher via a brokered issue versus buying a CD directly from a bank? Are these things FDIC insured? Well, yes, they are FDIC insured. You can see that in this column, the attributes column, FDIC, etc. And the reason why the rates of interest are so higher, it really just comes down to scale. So for example, Fidelity has the financial wherewithal to be able to call up Morgan Stanley and say, look, we have customer demand for certificates of deposit, so we're willing to buy let's just say $100 million worth of your CDs that we want to resell to our customers. Because they have that buying power, they can negotiate a much higher rate of interest. So what's the catch? Well, there is no catch, but there are some key differences from purchasing a CD directly at a bank, and I'm going to focus in on two that I think you should be aware of. So the first thing I wanted to mention here is sometimes what you'll see with brokered CDs is they are callable, which simply means that a bank can redeem the CD before maturity. So why would that happen? Well, let's just say you bought a one-year CD that paid 4.5%. If interest rates suddenly fell dramatically and now the market rate for CDs was only 2%, well, in that case, a bank, if it has the right to do so, it's going to want to call in all of its outstanding CDs at 4.5%, so it can just reissue at 2%. And that is a risk in some cases here. But you can screen these for what's known as call protection. So if you look at the attributes column here, and if you see this designation CP, that means call protected. In other words, the bank cannot redeem the CD before maturity. I think I only saw one in the list here. Yeah, it was way down here, this Saffron National Bank. This is the only one that I'm seeing that isn't call protected, but it's something you want to be aware of because, obviously if you have a nice yielding CD and the bank calls it in, well, then you got to find a reinvestment, and chances are if rates have gone down, you're not going to be able to get that same rate. The other key difference, and I think this one's probably actually more important, is what if you need to get your dollars out early, that is before maturity? Well, that's a great question. If you go to your local bank and you purchase a one-year CD, you want to get out early, usually you can get out, but you might have to give up a few months worth of interest as a penalty. It's usually not that big a deal. But with brokered CDs, that is not an option. The only way to get your money out early is to sell the CD back into the market. That might sound a little intimidating, but it's basically the same concept. If you want to sell a stock from your portfolio, well, you just have to sell it back to the market and take whatever the market's offering. And the same is true for brokered CDs. So again, the risk is if interest rates go up and you have a fixed rate CD, and let's say you had to get out of it, if the market has moved up, chances are you're going to have to sell that back at a discount. Now, this probably isn't a huge risk for most people. If you're buying short-term issues, you can just wait to maturity because, again, these are FDIC insured. As long as you hold to maturity, you're going to get your principal back. But if you were buying something like a 5-year maturity, well, that could be a real problem, if you're only a couple years in and you got to get your money out. So if you think there's a fair chance that you're going to have to get out of a CD early, you're probably better off going directly to a bank. So again, with short-term interest rates spiking in 2022, if you're looking for a way to play that's pretty straightforward. Brokered CDs are a great option. Like I said at the beginning of the video, they're just simpler than buying treasuries directly. So anyway, look, I hope this was helpful. If it was, just do me a favor, slam the thumbs up button. It just lets me know you enjoyed the video. And as always, I hope we'll see you in the next one.